Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is Monday, July 22nd. Quickly wrapping up another month here. Just a little over a week left in this one. And today we're going to take a look at one out of the communications sector, Verizon Communications. Let's jump right in. Now, before we get too far into the video, if you could do me a favor, or if you are new to the channel, if you could hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hit the notification bell so you're notified whenever we put out any new content. I do subscriber or viewers requests here as well. So if you have a company like Verizon you would like me to cover in a stock pick of the day video, again, drop it down in the comment section below and make sure that notification bell is clicked so you're notified whenever we put out that video. I really do appreciate everyone out there who has taken the time to do that. Doing that really does help out a small YouTube channel like mine. It doesn't cost you a thing, but it does work to help push the YouTube algorithm to push out more of these videos to people. The more you like, the more you subscribe, or the more people that like the video, the more people that subscribe, and the more people that click the notification bell and drop a comment. That helps with the YouTube algorithm to push out these videos a little further. Watch time does help as well. So if you could watch these videos to the end or just watch a little bit more than you normally would, that would really help as well. So really appreciate everyone out there, and a special thank you to the subscribers out there. The channel continues to grow because of people like you. Thank you so much. Now, this is the vested interest stock screener. This is how I look at a company on a high level to see if I'm interested in investing. It's where it starts. If it meets 5 of 8 or 6 of 9, that doesn't mean I'm buying. That means it goes onto my watch list. If it's already in my portfolio, this is a back check on the company to see if I am still interested in the company and still meets the initial screener that I set up. Again, if it doesn't meet these, maybe there's something wrong. I need to do more of a deep dive into the financials, look at the balance sheet, the income statement, and make sure there's not something going on with the company. You tweak this screener however you like. It is really set up for dividend growth investing. Some of these are not going to work for those of you out there who may be buying stocks that don't pay dividends. Dividend payout ratio of 75% or less. Growing dividend wouldn't work. Dividend yield theory would not work. So there's a few of these you'd need to tweak if these are not used specifically for dividend growth stocks. So you go ahead and tweak it how you want, change what you need to, no problem there. It should just be a starter. Don't blindly copy anyone's investing criteria, even a screener on YouTube. Make sure you are making it your own. Now, if you want to know more about this company, Verizon, check them out at www.verizon.com. That's www.verizon.com. That is their homepage where I pulled this information from. Verizon Communications was created on June 30th, 2000 by Bell Atlantic Corp and GTE Corp. In one of the largest mergers in U.S. business history, GTE and Bell Atlantic evolved and grew through decades of mergers, acquisitions, and divestitures. Today, Verizon is a global communications technology company delivering the promise of digital world to millions of customers every day. And that's what they are, right? Your cell phone may be on a Verizon network, your home internet or TV cable may be on a Verizon network, your cell phone may be provided to you by Verizon. That is really what they are. They are around all things communications, and that's for personal use as well as business, small business, and large business as well. Now, the reason we were taking a look at them, down 6.04%, big drop on the day, closed out the day at $39.10. We are talking about Verizon Communications, ticker VZ, out of the communications sector. 52-week range as low as $30.14, as high as $43.42. So they still are closer to their 52-week high than their 52-week low. Market cap of $164.603 billion, a beta of 0.39. So they are less volatile than the overall market, even though there was a bit of a volatility throughout today. PE ratio, price to earnings, is very low at $14.69. I like whenever they're under 18, 15 here, even better. EPS sitting at $2.67 per share. Earnings date was today, so you might want to check that out and see what negativity came out of their earnings report that had them dropping 6% on the day. Looks like they're down a little bit more in the after hours, at least whenever I pulled this. Forward dividend is $2.66 paid out on the year. They are quarterly payers, so divide by 4, though we will cover that here in a little bit if you just give us a little bit of time here towards the end of the video. And very, very high dividend yield, 6.39% on this one. Ex-dividend date was July 10th. They're going to pay out on August 1st. Unless you own them now and owned them before July 10th, you would not be in line for this August 1st dividend. And if you were to buy them now, you would not get the dividends on August 1st. You'd have to wait a few months to get paid out. 1-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $45.42 per share. So they see some upside as far as price appreciation goes. We're going to jump over and look at dividends and splits here. If you were to go over here on the left on Yahoo Finance, where I pulled this information from, you'd see a bunch of tabs. You click on to statistics, you go down to dividends and splits. We're going to look at dividend yield theory. We take a look at their 5-year dividend yield average of 5.38%. We compare it to the current 6.39, or over here where it says forward annual dividend yield 6.39, same number, right? 6.39%, 6.39%. And since it is higher than their 5-year average, that speaks to undervaluation, at least according to dividend yield theory. Now here, I don't like this. Payout ratio over 75%. I like 75% or less. Their payout ratio over the last couple quarters has crept up, now sitting at 99.16%. That's dangerous. Now, we don't want this to stay elevated for very long. If this was to stay elevated, for more than a quarter or two or three, then they would be potentially looking at a dividend cut. So you really want to watch this, right? Payout ratios, I like 75% or less. Maybe yours is 70 or 60, but at least at 75% or less, that still gives them some room to pay down debt, make acquisitions, buy back shares, do some other things that they need to do as far as a business. This payout ratio is very elevated at 99.16%. And I believe we did a review on this as recently as January of this year, and it was much lower than this. So something to keep an eye on right now. Now we're going to take a look at free cash flow. We want growing free cash flow over time, because if companies have growing free cash flow and they pay a dividend, typically they have growing dividends to go along with it. Going back to 2021 here, you can see negative free cash flow. That's not good. Negative $28.3 billion. 2022, big jump up to 10.4 billion. 2023, another jump up to 12.9, and the trailing 12 months so far. Now, keep in mind, this does include part of 2023, and what's been reported so far in 2024 is at 13.4 billion. So it looks like they are going to continue to grow, though we'll have to wait to see how that really shakes out over the next couple of quarters to see what is reported out in 2024. And what is indeed part of 2023 numbers. Now, you also can see their repayment of debt. They are significantly paying down debt, but it does not look like they are repurchasing any shares. But repayment of debt on its own is not a good metric. You would have to look at this compared to how much debt they were accumulating for those same years and see if they were paying down more debt than they took on. Now we're going to jump over to stockanalysis.com. This is another source that I go to for information. I am not affiliated with stockanalysis.com. I am not affiliated with Yahoo Finance. Just two sources that I like to go to for information. And I always recommend more than one source for information so you can make sure the information you are getting is accurate and up to date. Now, they do have 15 analysts that have taken a look at this. They call it a consensus buy, though it is pretty close to a hold. And whenever I clicked on that, there were quite a few that called it a hold. Some called it a buy. Some called it a strong buy. No one called it a sell or a strong sell. So they do consensus. The overall consensus is a buy with a low estimate of $36, which would be a 7.93% decrease from where it currently sits. Average estimate of $44.30, which is pretty close to what we saw with Yahoo Finance. That would be a 13.3% increase. And if it happened to hit their high of $52, that would be a 32.99% increase. All the while, you could collect that 6+% dividend yield. Now, we're going to jump into the statistics here, look at return on equity and return on invested capital. That really tells us how well a company is reinvesting its funds back into itself. And I like 10% or better for these metrics. So return on equity sitting at 11.9% is a plus there. But return on invested capital is lower than I like at 5.95%. I want 10% or better for both these metrics. So a little low there. And even though it got one and not the other, I do not give a check for that. It's got to be both. This is an all or nothing deal, in my opinion. I guess you could split them up if you wanted, but I keep them tied together. EPS growth, I like 5% or better forecasted over the next 5 years. Their EPS growth over 5 years is sitting at 13.16% estimated. So very high there, much higher than the 5% I'm looking for with revenue growth. Slow revenue growth, but still growing 2.1%. At least, again, according to stockanalysis.com's numbers. Let's jump over to the dividend history and wrap this one up. But first, we'll take a look at my position. I am long Verizon. I do have a significant position here. I have 339.841 shares. I have $13,980.18 into the position. I am down 4.9%, or down $846.20, and really down today. But that doesn't mean anything unless I sell, just like whenever I was up before today. It didn't mean anything unless I sold. So I do currently have $13,297.98 if I was to sell. But I'm going to hold. I will probably add to this over the next couple of weeks, if not months, and run this up to 400 shares if it presents buying opportunities. I'll probably wait for it to drop a little bit more. If it does, maybe I just nibble a little bit, 2, 3, 4 shares here and there. Now, they are a quarterly payer. Again, elevated payout ratio, 99%. That's too high. We want this to come down. We want this to be under 75%, or at least that's the number I put. If you want 60, 65, or 70, 50 maybe even, that's up to you. But I pick 75% or less because, again, 25% of free cash flow to pay down debt, make acquisitions, buy back shares, reinvest back into the company, in my mind, is perfectly fine. Slow dividend growth on this one, I will say, 1.92%, but it is growing. And when you start with a 6+% dividend yield, you don't have to have a lot of dividend growth to keep this one returning significant amount of funds to you. It does have 19 years of growth. Buyback yield is negative, so whenever they are buying back shares, they are not doing it very efficiently. Shareholder yield is 6.56%. They do pay out on the February, May, August, November timeframe. I like that. A lot of companies pay out on the March, June, September, December timeframe. So I like that this one is in the off month, what I consider the off months to most companies. It helps me to spread out my dividends. I like dividends every month. So if you have some that pay in, the March timeframe, some in February, and some in January, that will help give you monthly dividends, even if you don't have a company paying monthly dividends like a Main Street Capital or Realty Income or some of the others out there. Now, 2022, they were paying 64 cents in January. In October 2022, they raised it up to 65 and some fractions of a penny. In October 2023, they raised it up to 66 cents and some fractions of a penny, and I would be willing to bet in October of this month, if they're going to continue this dividend growth, even though it's slow, it will be in October that their next dividend raise is. All right, let's jump back to the screen or see how we're looking. Understand the business. That's where we started. Growing free cash flow. No, we had a down year 4 years ago, and the trailing 12 months, we'd have to wait to see what 2024 shakes out. So I would say no to growing free cash flow over the last 4 years. Definitely looks like over the last 3, but not the last 4. Growing dividend, yes, 1.9%. Even though it's slow, it is growing. Dividend payout ratio is elevated. 99% is too high. No check there. Check valuation based on dividend yield theory. Dividend yield theory says it's potentially undervalued. Check there. It is below my cost basis, but it is not within 15% of a 52-week low. So I'm going to give it a check there. If it's not in your portfolio, it would not, and below your cost basis, it would not get a check, right? If it wasn't in my portfolio, it would not get a check. Keep that in mind. Return on invested capital and return on equity. We got one of two, but we don't get a check for one of two. We need both to be 10% or better. So no check there. And earnings per share growth of 5%, check there. So we do have 1, 2, 3, 4, 5 of 8 makes it investable. It is in my portfolio. It is one, I'll be honest with you, I am going to do a little bit more of a deep dive into the financials and see how this one is shaking out. Just because if I was to take this out of my portfolio, it would not meet 5 of 8. It would only be 4 of 8, right? So I want to watch this one, especially this. Dividend payout ratio of 75% or less with a 99% payout ratio. If that continues for very long, it is definitely one that could be a dividend cut. And we don't want dividend cuts around here. We've already had a couple companies do that. We don't like that. So I'm hoping they get their stuff together here over the next couple quarters, but I will be watching this company. That is Verizon. Let me know what you think of it down in the comment section below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey into financial freedom. Join the vested interest community. And drop a comment down below. Let me know what you think of Verizon. Is it in your portfolio? Is it one you're selling? Is it one you're buying? Is it one you're waiting to drop a little bit more and then add it in? I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and an investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money, so never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.